if it would be so simple, computers would be the best investors, full stop. Which they are not always. I mean, they have some algorithms which do quite well, but if it would be so easy, just looking at a few numbers, um, why would we invest as an individual investor then? Because it's much more than just the numbers, because it's also looking at management and looking at how their execution is and looking at the market, et cetera, et cetera. I mean the total addressable market and the acquisitions which you have to factor in, et cetera, et cetera, et cetera. So there are so many parameters there that it's impossible to quantify them all separately and then come to a certain price. And a lot of people are attracted to target prices, and I think they're ridiculous. Because you cannot know what the market will do, you cannot know what a stock will do, but you can also not know how the market will value certain results, etc. So yeah, I think a lot of people are drawn to that simplicity, but simplicity is always
because it's easy to grasp and it's easy to work towards, look towards.
Yes.
I mean, complexity.
Yes.
Not everybody
And
wants to live to the complexity.
And I always say, I mean, valuation. I'm honest in that. I don't think in general I'm better than the markets to value a stock. There are certain exceptions, and I have spoken out, that about Plug Power, for example, which I don't think has the quality to be so expensive. But in general, I think if you have a you will be a much better investor if you look at the quality of a stock than if you look at the price. That's
so you don't go by any of these matrices like DCF,
I've done them when I started out, and I read it somewhere, and I thought it was great that DCFs are like a telescope. If you move them just a little bit, you're in a completely different universe. So, and I thought that was completely how it is. So if you just adjust a few things there, you get a completely different price. But again, it's that attraction of, it's simple. You get a target price. Oh yeah, baby, this one is overvalued, I'm going to buy it. It's not so simple, and people often want simplicity, but it's not what they should try to find, because simplicity is always, it's not the truth in life. It's not black or white. It's gray, and there are, we all know there are 50 shades of gray, I think. So
something like that. I mean, I do talk about this in some of the investing forums, that how many people, let's say, now Amazon has matured. The business model is clear. The cloud, they have e-commerce. Now they're going to telehealth and all that stuff. I mean, they can keep doing what they want to do. But in 2002 and 2003, which DCF would have projected Amazon's price for today?
None. And you can look at all the best companies. Look at Tesla, which still looks ridiculous. Look at Netflix, look at all the great stocks, even Apple at certain times. Yeah, I mean, the best stocks always keep amazing people because just very often, because of what I have just said, that they compound those beats, and that they always crush the expectations, and that is, I don't see many people or many investors stress that enough, that if you compound those beats, that you will not be in the same room anymore than just the expectations of the analysts. So it's a completely different world.
No, Chris, I understand this, and there's a lot of it is come by experience. I guess when you start investing yourself, you get a certain philosophy, and then you build your own philosophy, build your own thesis. But at one point of time, how should a common investor look at a stock and the price equation? Let's say any stock, for example, let's say CrowdStrike. Now, if I have to invest in it, how do I invest on it? And
what I do, and that, Rajeev, I look at the quality, and if I pick a potential multi-bagger stock, then I write 5 articles about it. And the very last point I look at is valuation. And that's how every investor should do it, I think, because all the rest is much more important than valuation. And valuation is only the last thing. And if you think, whoa, man, this is crazily overvalued, if you think that, it's often a good thing. And how do I do that? I just start investing with a small position, and I look what happens over time, and I scale into positions over months and sometimes even years. And then you see how that company, that expensive company, grows into its valuation or not. You know, if they completely crush the expectations, they will grow to their valuation. Amazon doesn't look that crazily overvalued anymore because they have been outperforming year after year after year after year. And then all of a sudden, I mean,
they look undervalued actually.
yeah, true. So, but if you even 5 years ago, it was, you know, it was a commonplace to say, oh, Amazon is so overvalued, even 5 years ago. And you know, that's a quality I'm looking at. So look at management. If you look at Jeff Bezos, you know, he's a great leader. Look at the execution, how the company does, how they beat the expectations, etc., etc., etc. And all those things are much more important than valuation. And again, in general, the market will know better what it's worth than you as one person.